Welcome everyone to tonight's asset protection webinar. Tonight we're going to be talking about the impact of the CARES stimulus package on real estate investors. And we're really excited to have Steve Roof with us tonight. He's the president of Cost Segregation Authority. Before we spend the time or turn the time over to him, I wanted to make a couple quick little announcements. For those of you, there we are. For those of you who have registered for the Anaheim Summit, we've made the really hard decision. We've talked to all the speakers, we've talked to the hotel, we've talked to the governor's office, and we in California, and we've kind of made the decision that June 1st, 2nd, 3rd is not going to work. They're still allowing no more than groups of 12 people in. So the Anaheim event is, as much as we hate to do it, we've got to move that until February of next year. So the upcoming events right now we have scheduled is Phoenix, July 27th through the 29th. We're adamant about having that one. It may be reduced size, but we're going to go ahead and hold that one. And also the one in Orlando, September 14th through 16th. And so if you've registered, you'll get an email tomorrow for the Anaheim event, giving you options to go somewhere else, either to Phoenix or Orlando, or maybe meet with us privately over Zoom or Skype. But there'll be some other options for you. But know that we will not be doing that. I know that this is kind of last minute notice. Well, it's 4 weeks out, and we've had a lot of people that have wanted to book their travel but have been holding off. So there's our final decision on that. For the upcoming events, if you'd like a sample agenda, they're available on our website at protectwealth.com. We are still planning on holding the cruise. Even, we're not promoting it heavily, obviously, but we've talked to the cruise planners, we've talked to Royal Caribbean. We don't know what's going to happen between here and December, but we're not backing off on it. If you registered, and even if you've paid a deposit, your deposits are fully refundable up until August 1st. And so don't back off on it. I'm still looking forward to what we do on the cruise. We've had over the years some incredible speakers and incredible content and some incredible students. So they've become our best friends over the years. And so we appreciate all those who have cruised with us in the past, and we're still planning on that. Before we turn the time over to Steve, as always, we cannot give legal or tax advice. We can teach general principles. How they apply to you and your situation is really for you and a professional. And so we'll give you the opportunity for a free consultation at the end of this. And that's also why we do one-on-one consults when you come to the summit, is in one-on-one. Then we can cross the line once we know a little bit more about you and cross some of those barriers. But here we can only teach principles that apply in general, but not specific to you. All right, so with that, there's so much. We're so excited to have Steve with us. He's an expert on cost analysis, cost segregation for real estate investors. There's so much money that could be used right now for real estate investors. We could get such a bigger amount of depreciation if we can move it forward. And so, but this CARES Act really changed the game on cost segregation and some of the benefits for real estate investors. We couldn't think of anyone better than the president of Cost Segregation Authority. And so, Steve, thank you for being with us. And so we're going to turn the time over to you and let you kind of give a little of your own background, but delighted to have you. Thank you for being here.
All right, great. Thanks. I'm excited to be here tonight, excited to talk about some of the CARES Act, its impact on real estate, I've been in the cost segregation business now for 15 years. Have done studies all over the country. It's exciting right now. The hard part for us is typically we do a site visit when we do a study, and right now it's hard to travel all over the place, but we found some great ways to do some virtual site visits and do a couple other things as well with what's going on right now. So excited to talk a little bit about this. So here's some of the objectives that I hope to talk about tonight. I'd like to be able to help you learn more about it and really how you can use this in if you own real estate or if you are somebody that is looking at real estate, how you can really understand this and its power. I'd like to identify a few of the aspects of, I have a couple of acronyms down there. The TCJA is the Tax Cut Jobs Act, more commonly referred to as the Trump tax cuts. And then the CARES Act, which is the most recent coronavirus act and how it affects real estate. And then, what these things mean for each of us and as real estate investors. So this is kind of the objective, and at the end we will leave some time for questions so that you can ask some specifically about what I talk about. So I've got this kind of pyramid thing here to show that, with cost seg kind of as a base, the Tax Cut Jobs Act and bonus depreciation on top of that, and then the CARES Act. So these two things work hand in hand with cost seg and have basically made it so that this depreciation becomes on your real estate becomes a very, very, very significant item. And so just like showing that pyramid of that. So just a quick reminder on what depreciation is. So if I own a residential rental, I own a building, I'm going to depreciate that either over 27 and a half or 39 years. And so obviously that's a very, very long time. So the idea behind cost segregation is to say, okay, I'm going to break up this residential rental, I'm going to break up this office building into parts, some of which can be depreciated over 5, some of which can be depreciated over 7, some of which can be depreciated over 15. And so what that does, it allows us to accelerate the depreciation, take bigger tax deductions now, rather than stringing it out over 39 or 27 and a half years. So this is done using an engineering-based cost seg study. Again, one of the key components about depreciation to remember as real estate investors is that it's a non-cash expense. And as a non-cash expense, that obviously is very helpful in planning to improve your cash flow on properties, which this definitely does. So what happened, there's a section in the code, it's section 38. And what happened, there was a very large company called Hospital Corporation of America, and they had a bunch of smart people. They were cash strapped. They were looking for ways to minimize tax and to get cash back on their hospitals. Well, what they did is they broke their hospitals down into parts. And they used this section 38 of the code to do it. And what happened is that when they did this, it resulted in a $700 million difference of what they said their deduction was to what the IRS said it was. It went to tax court in 1997. Hospital Corp won on almost everything. And so that's when modern cost segregation was born. And so this isn't something that's extremely new. Some of you may remember when President Trump, his people said, man, you have a $900 million tax loss. How does that happen? And I'm thinking to myself, I can tell you exactly how that happens. You own a bunch of big buildings and you do cost segregation studies on them. But here's the idea behind section 38 of the code. If property can be removed without damage to the building, then it's personal property. So think about things like carpets, countertops, window coverings, blinds, portions of the electrical, portions of the plumbing, those things that can be removed. And what happens then is those items meet this section 38. So that's what Hospital Corp did. The next one is way more interesting to me, and this is the relationship between the asset and the equipment that they would be retired together. So let's take a residential rental setting, and let's say that I have a dishwasher. Well, that dishwasher The dishwasher itself is obviously a 5-year asset, personal property. Well, what about the electric that goes to it? Or what about the plumbing that goes to it? Those items are specifically for the dishwasher, so that electric, that plumbing should definitely be part of that. So in a manufacturing setting, if you're thinking of a manufacturing setting, let's say I have a piece of equipment. Again, that equipment will have a short life. Well, if I had to pour 10 inches of concrete for it to sit on, if I had to do run electrical, plumbing, HVAC to keep it cool, all of those items, if they're specifically for the electric, for that piece of equipment, they would have the same life as that equipment, and so they would be depreciated over the same life. So that number 2 is really powerful when you start thinking about a residential rental, for example, because I have all these appliances, a washer, a dishwasher, a refrigerator, all of those things that can be specialized, even if they were structural components of the building, would be related to that piece of asset and would then have the same life as that asset and be depreciated. So it creates a very, and as I go on to show some examples, you'll see how powerful this is. The last one in section 38 is the relationship between the asset and the nature of the business are unique. And so what that means is something like snowmaking guns or gas station canopies or things that are really specific to your trade or business would fall under these section 38 assets. So this is what Hospital Corp did. This is what we're trying to bring to the average investor to say, look, we can apply this section of the code. And then again, if you're thinking about my pyramid back at the start, we'll then apply the cost segregation with this to the Tax Cut Jobs Act and then with the CARES Act as well. So my slide wouldn't trade. So just to give you an idea, here's some of the things that typically get reclassified. You see some of the land improvements. You see people laugh when we go out to do a cost seg study because we count the bushes, trees, and shrubs. They're like, "What are you doing?" And we're like, "Hey, these are tax deductions. We want to count these things." Some of the 5-year things you can see: plumbing, parts of electrical, carpets, cabinets, etc. So this just gives you an idea of some of the things that may be segregated. Okay, so let's talk a little bit about the Tax Cut Job Act now that I've given a little background on depreciation and cost seg. So the Tax Cut Job Act had lots of things. It had child tax credits, Section 179, individual mandates. Well, the big thing related to real estate is bonus depreciation. So under the old law, there was this table here. You can see that there was some period of bonus depreciation, anywhere from 30 to 100%, depending on when the buildings were placed in service or the assets. And the big requirement was that it had to be brand new, so new construction. And it has to take the bonus, it has to be a recovery period of 20 years or less. So what that means, remember when I was talking about a building, it's a 39-year asset, it means it wouldn't be eligible for bonus. But what happens is, even under the old law, a cost segregation study, you do that, the 5, 7, and 15-year assets are identified. They then can be taken for bonus depreciation if they're new. Now, so under the Tax Cut Job Act, that table went away and some of these other things went away as well. And so now what we're calling this under the Tax Cut Job Act is super bonus depreciation. And here in a minute, when I show you the examples of this, you're going to be shocked at how big the numbers become for people that own real estate. So the big issue on this is that you see it becomes 100% from 9/27/17 all the way through the end of the December of 2022. Now, they also made it so that existing, the property begins as use as when the taxpayer buys it. It doesn't have to be brand new. So what that means is this: I go out and buy a building now, even if the building was built in the 1800s, it becomes new to me and becomes eligible for bonus. And that is what's so exciting about this, because, and not only is it eligible for bonus, it's eligible for 100% bonus, which means I expense it, is what happens. So let me show you an example here so you can see the numbers. So this is an assisted living facility. Acquisition cost 1.2 million. It was bought in 2019. So that is obviously in that 100% bonus period that we were talking about. And the current tax year is 2019 as well. So what happens is I do a cost segregation study. Some of the things that get reclassified from 39 years to 5 are cabinetry, appliances, counters, portions of the plumbing, portions of the electrical, specifically related to the dishwasher, the disposal, the refrigerator, the washer and dryer, ceiling fans, carpets, blinds. Those are the kind of things that get reclassified to 5 years. Some of the things that get reclassified to 15 years, and again, remember now these are going to be 100% bonus eligible: retaining walls, grass, swimming pools, outdoor lighting, bushes, trees, shrubs, storm drains. Okay, any land improvements out there will be segregated to the 15-year class. So what happens is this: without the 100% bonus, this is what it would look like. Your first year increased depreciation from doing a cost seg study would be $43,000. Hey, it's a great deal for doing a cost seg study, and you can see what happens on the years after. So again, doing a cost seg without the bonus was good, but now let's look at this with the super bonus. Basically, my depreciation goes up to increase of 318,000 or 339,000 in the first year. So again, because of this Tax Cut Jobs Act, this 100% bonus, when I buy something, do a cost seg study, in the first year, I'm going to take 100% bonus on the 5, 7, and 15-year assets. Now, again, this creates humongous numbers. So we had actually done a few studies at the end of the year 2017 before this law went into effect. And after the law changed, we came back and said, hey, we need to update that report, the new bonus depreciation law. And what we were finding is we were finding deductions that on $1 million building that was going from 30,000 to 300,000 plus. So the numbers were just staggering with this super bonus depreciation. So again, the 100% bonus runs through the end of 2022. So if you have bought any property from after 9/27/17 until the end of 2022, it's going to qualify for this 100% bonus if you do a cost seg on the 5, 7, and 15-year assets. So again, this is such, for real estate people to think about this, in context, it becomes very, very large. Now, something else that's interesting is sometimes people say, holy smoke, this 300,000 is bigger than I need. So what can we do? Well, we can also elect out of bonus by the 5, 7, and 15-year categories. And it's an interesting way to actually use tax planning and minimize or maximize the depreciation in the year that you want it. So with that, there's another interesting thing that I want to talk about. But before I do that, here's a slide that just gives you a feel for what items, what percentage of assets. So if I was taking $100,000, this shows on an apartment building, I would reclassify 35,000 for every 100,000, or 35%. So there's different type of buildings have different kind of assets that can get segregated at different amounts. Okay, so one thing that I think is really important for everyone to realize too is this thing called a catch-up benefit. So let's say I bought a property in 2005 or 2010, and you think, oh man, I didn't do a cost seg, I guess I'm hosed. Well, the answer is you're not hosed, because the IRS allows what's called a 481A adjustment, which is this. Everything you should have taken in the years that you owned the property, you can take in the current year without amending any tax returns using the Form 3115. So even if you bought a building in 2017 after 9/27 and you didn't take the 100%, we could then take the 100% here on a 2019 tax return. So it's an unbelievable way to put deductions in the year that you would like the deduction. So back to our $1.2 million example, this is saying, okay, I bought the building in 2014. I do the cost seg study here in 2019. voila, I'm going to take a $203,747 deduction in the current year. So again, for people that own properties, even if you haven't done a cost seg, it doesn't mean that you've lost out. You can now do it immediately in the current tax year. It also allows for some great tax planning, and especially under the new CARES Act, where there's a 5-year carryback window for net operating losses. Let's say, you know, you're going to have a net operating loss here in 2019. You own a bunch of properties that you haven't done cost seg. You could do those cost seg studies in 2019, make your net operating loss even larger, and under the CARES Act, you could carry that back 5 years and get refunded taxes that you paid as far back as 2013 under the CARES Act. So again, there's a bunch of tools that we're talking about that as real estate owners, you have a lot of tools right now based on the Tax Cut Jobs Act, based on the CARES Act, of where and how you put deductions, and you can maximize your tax benefits from owning these properties. So this again just shows some of the benefit of the catch-up, which is that 481A adjustment, the top number, and you don't have to amend any returns. You can take it in the current year. So let's just look at a smaller example, just so we can have it. Acquisition cost of $285,000, bought in 2014, current tax year 2019, and you know, here's what happens. We have, you know, a nice $46,000, again, on a $285,000 purchase. So these deductions get very big very quickly. And so when we start talking about cost segregation, I get super excited, because a lot of times it gets to the end of a tax year, or here we are sitting in, you know, May of 2019 or 2020, and you're like, oh, my 2019 taxes, I'm going to have a big tax bill for 2019, and you know, the COVID's affecting my business is not doing well. Well, voila, here it is. We do a cost seg study, even for the 2019 return, create deductions, go get money back, your refunds, etc. So it's something to do. So we get asked a lot, you know, when should I consider a cost segregation study? When should I do a cost segregation study? And this is kind of a list that helps you to know. If you currently own property, it's worth looking at. If you purchase an existing building or build a new building, you should look at it. Renovations, remodels, leasehold improvements, especially with changes made in the CARES Act. If you've made improvements, there are some significant benefits to improvements made on non-residential properties. Before you sell a property, it makes a lot of sense to do a cost seg study, because we can actually manage recapture and manage use rate arbitrage and actually save you money. That's a more complicated issue that we don't have time to talk about, but if you have an individual situation, we'd love to talk to you about that. And then property with a 754 or other type of step run scenarios, you know, if you have a step up in be some my estate, that's what a 754 step up is. They get a step up in basis. It becomes a great time to do a cost seg study. There's also another thing called a partial asset disposition, and this is another thing that a cost seg study really benefits, because it allows something like this. So let's say I buy a property, I put costs to things such as my roof, my doors, other parts of the building, even if they're 39 or 27 and a half year assets. And then I go, and a year later I replace them, and I remodel, and I put on a new roof, or I do new plumbing, or I do new doors. I can take a partial asset disposition on my previous asset that's now disposed, where in the past that would get caught in a 39-year number on the tax return and never be able to be disposed. And so now there's a way to dispose that using a partial asset disposition and a cost segregation study. So this is, again, another neat tool. And what we're talking about tonight is a lot of neat tools that we have as real estate people that we can use using cost seg study to actually manage and hold on to our tax. So let's talk a little bit about the CARES Act. So this is very recent, within barely over a month ago. It had all kinds of things in there, the PPP, the Paycheck Protection Program, with lots of people have heard about. There was recovery rebates for individuals, but there was a major change to qualified improvement property, and there was this 5-year NOL carryback. So two things for real estate investors that are very important that you should know about, which I want to mention briefly tonight. And then the last one is the 45L tax credit. It actually wasn't in the CARES Act, but was in the extenders bill, again, just a few months ago. That it's another powerful tool for real estate people. So under the CARES Act, the old law, there was, and this is related to improvements to non-residential buildings, they had multiple classes. What happened in the Tax Cut Job Act is they made class, which was called qualified improvement property. Well, there was a boo-boo in the Tax Cut Jobs Act where it didn't get a 15-year life. It was given a 39-year life, which again, remember what happens to our 100% bonus. If it's over a 20-year life, it goes away. Well, in the CARES Act, somebody stuffed this in there that fixed that in the Tax Cut Job Act improvements from 2018 on, 100% bonus eligible. So if you make any improvement to the interior portion of a building that's not residential, that improvement qualifies for 100% bonus and can be basically expensed. And that's going forward. So this is an exciting thing. So even we're getting people right now that had made improvements in 2000, and we're going back and doing it just like we do a cost seg, put it on the 19 return and create some significant deductions using that fix that was done in the CARES Act. So anyway, this is very important for anybody that does any improvements to an interior portion of a building where they can take this QIP or qualified improvement property. Excuse me. So the 5-year carryback is another thing in the CARES Act. So what this does is it basically says if you can create a net operating loss, and again, one of the ways to create a net operating loss may be using a cost segregation study, or if your business is doing poorly and you have a net operating loss. What the CARES Act has allowed us to do is it allows us to carry these NOLs back from 2018, 19, and 20 as far back as 2013, 14, and 15. And if you're actually a C Corp, what this allows you to do, it allows you to take deductions now that might be at a 21% tax rate, take them back and get things back from a 35% rate. So there's some really interesting things about this. We were working with a dentist, and he was able to create, we did a cost seg study, it creates an NOL. He's able to carry it back, in his case, to 2014 and get refunds. And again, remember when I talk about cost segregation, it was a non-cash expense. So here I'm creating a deduction in 2020 that can apply to the 2019 return that actually can be carried back as far as 2014 and get money refunded back. So this is a very interesting part. If you actually read the New York Times, it talked about that the CARES Act had big benefits for real estate owners. This is what they were talking about for big real estate holding companies. This 5-year carryback can be a very, very interesting tool. So here's an example. So let's say I have 100,000 of income in 2020. I do a cost seg, it generates a $525,000 deduction. You can see there that it wipes out all of the 100,000 income of 2020 and then goes back all the way to 2015 starting 15 and coming forward, and gets, in this case, would create $115,000 refund. So again, and you can carry it back up to 5 years under the CARES Act, which again is quite an amazing tool in the CARES Act. Okay, so if you look here, again, talking about my little pyramid, you've got a cost segregation study that you've done on your, then you then have the new tool of the super 100% bonus depreciation that allows you to take 100% bonus. Also, we have the 481A adjustment, and then the new CARES Act, with that creates, with the QIP and the loss carryback, creates some amazing tools that you can use. So the last kind of thing that was recently passed that I want to just tell you about is this 45L tax credit. And this is an actual credit. It's a dollar for dollar credit. When it finally makes it to individuals' returns, it's right underneath the child tax credit. So this is a general business credit, which also works under the 5-year carryback under the CARES Act. So this is a credit that can be carried back as well. But what it is this. Let's say that I build homes, I buy apartments, I build apartments. What the 45L tax credit is it's a $2,000 per credit per dwelling unit if it's 50% more energy efficient than a similar dwelling unit from 2005. So what that means is, again, is my unit today 50% better energy efficient than a 2005 unit after 15 years? And most new construction almost always qualifies for this credit. And again, it's a credit, it's not a deduction. So here's some ideas just to help you look at that. If you replace HVAC units or build with 13 plus SEER, you put in good insulation into your attic or walls, and you put in good efficiency furnaces. Those things basically help you qualify. There's some other things on here that help it has to be 3 stories or less, but these are the kind of things. So here's a couple common questions. Can a remodeling project qualify? And the answer is yes, it can. And again, it has to be pretty substantial because you have to replace some of those things I previously talked about. But you could qualify for this credit if you do. Can I apply for this for tax for past properties? The answer is yes. Can I be the one to certify? No, you have to have a ResNet certified person that certifies this. And is there a maximum number of units you can claim the credit? No. And this is something I failed to mention when I talked about the bonus depreciation as well. There are no limits to bonus depreciation, and there are no limits to the 45L tax credit. So these are things that they can be as big or as little, as you want. So these are some exciting things. Again, when you combine them all, it creates some really, you may qualify for one thing and not the other, or you may qualify to take the 100% bonus or the catch up, or you may have built apartments or remodel them and now you take the 45L tax credit. Well, you can work all these things together in a manner that can create some significant tax deductions, refunds, and other things. So these are exciting tools that we like to talk about, that every real estate person needs to know about these things. One thing that I'm often shocked about is how many people don't know about the 45L, they don't know about cost seg, they don't know about the bonus, even though they own lots of real estate. And that's not uncommon, because if you think about your CPA, your tax preparer has to understand 78,000 pages of tax code. And so even if they are a real estate centric CPA, they still might not be doing these things, or they still may not know a specialist that does these things. So that's where somebody like us comes in. We're like the brain surgeon for this real estate, we focus right on these two little things. We know everything about depreciation, 45L credits, and nothing about anything else. So that's actually kind of a joke. We do know stuff about it, but in general, we're going to help the CPAs make sure these things get implemented into your tax returns in a manner that creates the biggest deductions and uses your tax brackets the most efficient way. Excuse me. So what does this mean? Cost seg is an incredibly valuable tax strategy. You ought to know about it. The 100% bonus through 2022. So if you're thinking about buying properties, again, you have this 100% bonus available all the way through 2022. And with the CARES Act and extenders, again, these things all work hand in hand to allow you to really maximize your real estate and create the biggest tax deductions possible and increase cash flow using a non-cash deduction to do it. So there's a link here on Protect Wealth that allows you to, if you want a free analysis. So in our case, we will do free analyses. That's a funny word, free analyses. So we'll do those. You can just link on here. We need very little information to do that, to see if it's something that would work in your situation, and we can talk about your individual situations. With that, I'm sure we have some questions, and Dawn, I'm going to let you ask those to me. I'm going to take a quick drink. My voice is a little from talking.
Wow, this is deeper than I realized. I've known about cost segregation, but not really how much that can save a serious real estate investor. So let's hit some of the questions. Is this something that my CPA has already done? Or if not, is this something my CPA can do?
So typically, like I was mentioning, your CPA has probably not done this. In our case, when we're looking at a free analysis, we can tell pretty quickly whether you have had one of these done. But if you're not sure that you've had one, it's very unlikely that you have not done one of these. Typically, your CPA won't do this because it's a very highly specialized. It requires general engineering experience in conjunction with tax experience. And so what most CPAs do is they have someone like us that actually does their studies for them. So that's a great question, and one that when our free analysis, we can determine that very quickly of whether one's been done or not. But most likely, I would say probably not.
Let's say one has been done, but it was prior to the CARES Act and prior maybe to even the Trump tax law. Is it time to reevaluate it and redo it?
It might be, and it might not. So that's kind of a loaded question that I'm not going to answer fully, but it would be something that we could look at and determine with the analysis of whether there is any additional benefit. There may be, and there may not be, depending on what was actually done with that. But there may be an opportunity.
Okay, so Al is asking if I bought a building in 2018. I think you answered this. This is an earlier question, but let's hit it anyway. I'm starting to rehab this year. Should I file an amended return? What do I need to do? What do I need to do the study?
Okay, so you probably, here's what you'd want to do. I don't know when that question was asked, if it was before or after I talked about the partial asset disposition, but what you'd want to do, you bought it in 18, here it is 2019. We could do the study in 2019. You could take all the deductions in 19 without amending the return. All of the things that were going to be disposed of in the remodel, we would break out so that you could take the partial asset disposition and write those off as well. And then the new assets get put in service, and we do a And so it's kind of a three-phase whammy where we can get benefit, benefit, benefit in three different places.
Okay. Sid is asking, can I do this for a townhome or a single family home?
And the answer is absolutely, as long as you don't live in it. So this works for every property that's not your primary residence. So if it's a townhome that you own that you rent, or a residential rental that you own, this works for anything that's depreciable. So basically everything but your personal residence. Now, it would even work if you lived in a duplex and you rented out one but lived in the other.
Cool. Now, one of the questions that we always get is, what about the real estate that they own in their IRAs or 401ks?
So that's a really good question. So typically what's happening in there is you're not paying any tax on that real estate. So if what you could do to use a cost seg study is, that's a way to actually get it out of the IRA, because you can create the deductions that would allow you to get it out of the IRA and not pay tax. But in general, if it's still sitting in the IRA, you won't do the cost seg till you pull it out of the IRA.
Because it's already in a tax-free environment and you can't do depreciation in an IRA.
Correct. So as soon as you're ready to pull it out of there, that's when you do it.
Well, that's an interesting strategy. I haven't heard of that.
It's a very interesting one that people ask us about a lot. So.
Ooh, cool. That's kind of ninja. Okay. What about a multifamily? Is it considered residential?
Yep, multifamily is residential, and cost seg works great on them, and obviously 45L if it's new multifamily works well as well.
What if is there a certain number of units, like if over 8 units, then it's considered commercial, or does it matter?
No, you could have, if it's a humongous apartment complex, it's still residential. So if I have a 50 or 100 unit apartment complex, it's still a residential 27.5-year asset.
Okay. Is the 45L credit per building or per residential unit in the building?
Per residential unit in the building. So
Ooh.
that's a very good question. So even an assisted living facility, so let's say I have one assisted living facility that has 48 rooms, the credit would be 48 times 2,000.
Ooh, as a credit.
So even though it's in one building, there's 48 residents as a credit. So, so that credit would be gigantic, obviously.
That's cool.
So same concept works in an apartment. So in a big apartment complex, you have some of these big apartment complexes that are 300 units. You're creating a $600,000 tax credit, which is crazy.
Dang. All right. So the analysis, you do the benefit analysis for free, but what does it cost to have something like this completed?
That's a great question, and I'm going to give a gigantic range because every property is not the same. I mean, if I have a $50,000 residential rental in St. Louis, or I have a 50-story building in downtown Los Angeles, the cost is obviously going to vary widely. But most studies are somewhere between $1,500 and 10,000 most. And again, that's a huge range. But in our, the benefit is bare minimum 10 times the fee. Sometimes it's 100 or more times the fee, the benefit. So we try to make it a no-brainer. And if it's not a good candidate, we'll say, hey, your study's $1,500, you're only going to save, 9,000. Do you still want to do it?
And that's $9,000 this year.
Yeah, correct. But that's not 10 times the fee. So sometimes we'd be like, to me, I would take the $9,000 deduction, but sometimes it's like, hey, you have to pay $1,500 to get 9,000. but usually we hope it's way more than that.
So it may be really, really inexpensive for us to do this with a huge upside then.
Well, that's the goal. I mean, all along our goal has been, we want to take this. I mean, most of the gigantic people, you know, if you're building a 50-story building, they know about this. But we want to be able to take this to the person building a has $150,000 residential rental, or they build a $1 million office building for themselves. You know, because the numbers for them can be every bit as big and as powerful to them as it would be for a very large company.
Okay. Bill is asking, is there a minimum value on projects that you look for?
And that's a great question. And the answer with the new 100% bonus, the answer is no, there isn't a minimum value. We'll look at anything because, again, I'm saying a $50,000 home in Memphis, Tennessee, all of a sudden we're going to create a $20,000 deduction on that. And you're going, holy smoke, that's totally worth it. Whereas, you know, under that before the 100% bonus, we'd probably say, yeah, it's got to be 250,000 or more. Whereas under the new laws, it's like, I don't know, we should look at it to no matter what it is and see how big the benefit's going to be.
So even if somebody has a couple little rental properties, little residential, it's still worth doing it then potentially.
Yes, absolutely. So,
Okay.
and that's why we want to offer the free analysis to look and see if it makes sense, you know, and if it does, we'll say, yeah, hey, look here, you know, it's going to save you 20 grand or 50 grand or 10 grand or whatever. And then you can determine what to do with it from there.
Good. Herbert is asking, please talk about the impact on recapture if you implement these strategies.
That's a great question. And that's when I was talking about the sold issue, I kind of skipped over it. But here's what happens. This is actually a very powerful tool that helps you minimize the recapture. So what happens typically on a tax return is I buy a property for 100,000, I sell it for 200,000. What happens on a tax return, and nobody intends for this to happen, is you're saying the carpet is worth more when you sold it than when you bought it. Now, when you have a cost segregation study, that actually changes where it allows your tax preparer on the tax form 4797 to actually allocate the sale price to the carpet and to the building structure and to the land. And so what happens is you actually, at the end of the day, the carpet, it's not worth more, it's worth less. And so you allocate less to the carpet, and so you have no recap. It actually does, it allows you to take a deduction at your highest marginal rate, pick it back up as a capital gain, and actually save the spread. So what does that mean? And just, I mean, I went through that fast, but what general, if you sell a property and don't do a cost seg study, you're leaving money on the table because you could have allocated that differently if you had that done and actually save money. And it works very similar with a 1031 exchange as well. So again, that's more you were asking, you know, complex stuff. That's the complex stuff. And again, we're happy to talk about that with each individual in their situation. But that's kind of the key thing to think about is my carpet worth more when I sold it than when I bought it? And the answer is obviously no. So, and that's kind of what the quick answer to the recapture is. I'm not going to recapture on something like that.
Okay. Joan is asking, if I do a cost seg analysis, does it increase my audit risk with the IRS?
So that's and again another question that is very important. So the answer in our experience is no. So I myself have worked on more than 5,000 studies, and the number that's been audited is like 13. And of those 13, everyone is very, very large. So, I mean, you're talking the smallest one that's ever been audited in Utah, for example, is a $36 million apartment complex. So, you know, we've done had a few smaller than that audits in Seattle and in California, but in general, our experience is that this your audit risk the same as your audit risk on your regular return.
Okay, good. Now, do you guys work nationwide? Is there any place you don't go?
So I myself have I've done a study in 46 of the 50 states, and other people in the office or states that I haven't been to. So if you're listening and you're in South Dakota or South Carolina or Iowa or Rhode Island, those are the 4 places I haven't been. So, but I've got all the other 46.
So other than Alaska in January, you'd be willing
Yes.
to go anywhere, right? Okay,
Please,
got it.
please, Hawaii all the time.
Question,
Although right now we're not traveling as much, it's a little tough.
no, that's true. Does cost segregation make sense on residential rental homes? I think we answered that one. Yeah,
Yes,
absolutely.
the answer is yes. Yep.
Do I need to amend my tax returns? I think you've already taken care of that one. If you've taken
I don't need
depreciation
to.
on the rentals, yep, we're good on that.
Yep.
Folks, if you have questions, we're running out of questions and we still have a few minutes. But Bill is asking, what are the liabilities for non-certified people who do cost seg?
So what we've seen happen is if you do get audited in a regular audit and have one of these and it's not either winged or not done right, what we see the IRS do is basically just throw it out and say, yeah, you can't take that deduction. So in general, in our case, when we're all said and done, you'll have a 40-page report. Again, most of it's stuff that if you can't sleep at night, that's what you're going to want to read. But in general, it has you hand it to the IRS agent and they're like, oh, I don't want to deal with this. I'm going to move on to something else. And so that's what happens most of the time, when this does happen, when it does get audited. But we came to us to do a study because what had happened is they had built the building and their CPA kind of winged it. And the IRS basically said, hey, this isn't sufficient. We're not going to let you take that deduction. And so we did it, redid it, got them even a bigger benefit. And I think the IRS says we would have wished that they would have just they had after we were done, because it ended up being a larger benefit.
But a company like yours that does it professionally, that's what you do. That's that's your business. I don't see you get a 40-page analysis put on the IRS agent's desk. I don't see that they're going to question something like that.
Yeah,
because the agents
typically
aren't
not
trained in this.
The agents are not trained in it, and we've dealt with their specialists out of wherever the area they are, and most of the time, if it's a very large one, they'll get a specialist, and if it's not a large one, they look at it and go, yeah, I'm going to look at your Schedule C, or I'm going to look at your LIFO, FIFO issues, or something unrelated to cost seg.
Good. Well, it looks like this all the questions that we've got. Again, if you have questions, type them in and we'll try to answer them. So Steve, any closing comments? The free analysis, it seems like a complete no-brainer if somebody has real estate investments that are not in their IRAs.
Yeah, and it is. It's a complete no-brainer, and that's what we want. Our goal is to actually save people money on their taxes. So what we're going to do, we want to look at it before anybody pays us anything. We want to make sure that they're actually going to have a tax benefit from doing this. And so in our case, we're saying, let us look at it. We'll tell you what we anticipate the benefit to be, and here's what the fee will be. So everything up front. I anticipate a whatever tax savings, the fees, whatever, and then everybody knows. So that's our goal, and our goal is also to help CPAs. So we don't replace people's CPAs. We don't want to replace them, but we work hand in hand with them. So if somebody has an example, wants us to talk to their CPA, we actually include that with our study. We'll say, hey, we'll talk to your CPA, make sure they know how to put this in your return, make sure they know which boxes, if they don't know where to put that, where it goes. And because again, we want to make sure that when you do one of these things, you get the actual tax benefit. And so that's the important part to us in that.
Well, I'd love to have somebody like you on our team. Just incredible knowledge, and I know that yours is a specialty that almost makes you kind of a one-trick pony, but it's good to have somebody that knows how to do cost seg, does it right, is up to date on all the tax laws. Thank you for being here, and we appreciate your
Yeah.
time. Any
Yeah,
closing
thanks
comments?
for having us. No, thanks for having us. I'm just was excited to be here, and you can see I'm excited about saving people money on taxes. So
Well, here's the benefit that I see is if I can get a bigger deduction for a real estate investor right now, and in this year, that gives them more money to put into the market, put more money into real estate, whatever they do best. If we can cut their taxes and not pay taxes for the next 5, 10, 15 years because of the rollover, if we can front load the tax deductions, and it seems like you got more money to invest right now. Again, it seems like it's a
it's a
no-brainer.
very exciting thing because you're right. Basically, what we're doing is we're creating deductions to allow you to do, again, whatever you'd like. But a lot of times we create these deductions and we see the money that people would have paid tax, they go out and buy another property, and then they do it again, and then they do it again, and then they do it again, and so it's a great tool.
Hey, Don and Steve, there's a lot of questions coming in, so I know we're getting short on time, but there are a
I'm not
lot of.
seeing them.
Oh, okay,
Oh,
not missing.
oh, yes, I do.
You
Okay.
got a lot. This is good. So there's a lot of questions. Depends on your time. If you scroll down, there are a lot coming in. So I know, again, if we don't have time to answer them all tonight, Steve, your team can answer them. protectwealth.com/CSA. The link is in the chat screen. I did put that there. It's actually clickable, and fill it out. It's a pretty simple form. Steve, I think you guys just need, on the form I saw, was the property address, the value, and the year it was purchased, right?
Pretty much. And from there, we can determine what else we need from them. But in general, that's all we need. Very little.
Okay. So you know what? I was not scrolling. So let's go through these questions real quick.
Okay, I can hit a few of them.
Can a roof replacement on a commercial building be considered qualified improvement property?
It cannot be included. It wouldn't be QIP, but it would be 179, which is something I didn't talk about. But you would be able to take the partial asset disposition on the old roof, and then you'd be able to 179 deduct the new roof if you qualified to take 179. Again, that's in an individual situation. I could answer that.
Okay. I'm just doing a full studs out rehab of a 1936 home and just closed on the sale of the property April 20th. Can I get a 45L for that?
Probably.
Okay. Do the analysis and let's figure it out. Okay.
Yep, probably.
How would any of the new rules affect investment land purchases, no building?
Oh, the new rules don't land purchases. There's really not a lot of benefit for anybody just buying land. There is something called in the Tax Cut Jobs Act called opportunity zones, which may affect, if you bought land and planned to build something, it would affect that. And again, that's something that is a totally different topic from what I talked about tonight, but that there may be an opportunity zone benefit, but nothing that I talked about tonight would benefit just land.
Okay, and he's got a new roof. Kenneth has a new roof to be put on a commercial building last year. Oh, he had it. What's the impact?
So he should take a partial asset disposition from that. So if we did a cost seg, we could figure out what that should have been. And then you also should 179 the new roof, 179 deduct it.
Okay. If you have an older building that you've already depreciated most components over the last 8 years, can you claim bonus depreciation on a new driveway without doing a cost seg?
Yes. So
Cool.
if you just did a new driveway, yeah. Now an 8-year-old property, I'd still consider doing a cost seg because there's would be tons of things to depreciate still if you've only owned it for 8 years.
Good. Bill is asking, can you elaborate on saving deductions for a future year? What if I don't need the 300,000 deduction in the first year and want to spread it out?
So there's a few options. You have an option to of the 5, 7, and 15-year categories, you can elect out of bonus by category. So you also could elect 50% bonus rather than 100% bonus. So any combination of 100, 50, and or no bonus by 5, 7, and 15-year life, you could do any of those. So what that does is, it allows you to shift deductions into different years using any one of those 3 categories as 50, 0, or 100.
Cool. All right, we're getting quite a few little comments like, holy crap, Batman, and this is so good. This is so great. Anyway, thank you for those.
I always love, those are always fun. Those are always fun ones too. Most of the time people are like, hey, this is too good to be true. And I'm like, it really isn't. I mean, the IRS has an audit guide on these things that tells their auditors people are going to do these because it's awesome. I mean, it says expect, I actually have a slide that normally says that, but on the interest of time tonight, I kicked that slide out.
Well, you consider who's the president of the United States right now. He's a real estate investor.
That's why I say you may never want him to date your daughter, but if you're a real estate owner, you'd be like, yeah, I kind of like your tax law. So
whether you agree with Trump or not, you know what, this is the game we're playing by. So, okay, Jack, do you only do a cost seg and pass the information onto my CPA, or do you do the tax return? No, he doesn't do the whole tax return.
nope, we just work with your CPA. Yep.
Okay. Should I consider, Al is asking, should I consider a cost seg on a single family I sold this year at a loss?
Oh, that's a good question. The answer is I'm going to give a big fat maybe. So we would have to look at the numbers, but I would probably say 90% chance it would make sense. We would look at what it produced, but probably.
So a bigger loss is better than a smaller loss.
Yeah, and it would depend on what the recapture looked like, and I did. I mean, a number of things we could look at. I mean, it still makes a lot of times. Let's say I owned a property for 5 years. I bought it for 500,000. I sold it for 4. It still may make sense to do it because there may be a way to make your tax benefit even better by doing that.
Okay, Sheila asked a question about just joining the webinar. Yes, this is being recorded and it will be sent out to anyone who registered for the webinar, whether you attended or not. And so, and it is a shareable link. So the recording it'll be posted on our website, but please, you're welcome to listen to any part of this again that you didn't get the first time. Henry, do I get a benefit from cost seg? How long do I need to keep the property? Can I buy and sell in the same year and still do the cost seg benefits?
That's a very good question for a tax year. So if I bought it in December and sold it in January, you could do it. If I bought it in January and sold it in December, I couldn't do it. Ooh. So again, 2 months, 11 months, and not do it. So it just has to be held over a tax year to be able to.
Okay. Josh is asked, what was the average cost on a study? I think you answered that, starting at 1,500, going up to whatever. So I think we're okay with that.
Depending on how big your building is.
Right. If someone is going to contribute to an office building or an office building to a charitable remainder trust, is there a need to do a cost seg?
I'd have to think about that. That one may be one where we'd want to talk to them. Just off the top of my head tonight, that I'm not sure. I would want to do a little more research on that one if you were gonna do on what that would do on the actual return. So I mean, that's something we can play with, and if that individual wants to.
Okay. Gigi is asking, do you actually travel to the property or what are you doing right now with this COVID-19?
So right now what we're doing is we are doing Zoom virtual site at a property somewhere where we're not. We would say, okay, we're going to schedule a virtual visit with one of our engineers, and they'll walk around with the Zoom. We'll record it. We'll ask some questions. We'll make them look at the electrical panels and a few things. So that's what we're making work at the moment. The IRS in their audit quality study, including a site visit. But under the current scenario, that's the best we can come up with. And because they're not going to extend the tax deadline any longer, it's what we're going to do. And if it gets audited, we're going to go, here's the video. You guys said we couldn't travel. This counts. So
good. Good. All right. Does it matter if a property is in the LLC or in a trust or in a corporation or?
Nope.
Nope. Won't make a bit of difference, especially LLCs generally are passed through to you anyway. It would reduce your taxes. The impact would be on whoever owns the LLC.
Correct.
What do you need for the analysis? Tax returns? What do you need?
Even simpler than that. We need to know the property, when it was bought, and that's about it. I mean, and how much you paid for it. I mean, those are kind of the three things. Other than that, once we get into it, if there's more information we need, we'll ask for. I mean, a depreciation schedule off of a tax return's awesome, because then we can tell exactly what's been done previously. Or a settlement statement's great. I mean, there's a lot of things that are great, but in general, we just need to know address, cost, and year bought.
Great. We're getting down to just a few more questions. Is bonus depreciation only available for commercial property?
No, you can do it on residential property too. So the bonus is for any type of property we can get under a class life of 20 years. So if you go back to, when you get my slides, if you go look at some of the examples of 5, 7, and 15-year assets, any of those would qualify for bonus, whether it's residential or commercial.
Okay, got it. All right. Hello. Did you no longer own it? I've got 15 rental properties, but can't qualify as a real estate professional. Is there any benefit for doing a cost seg?
Yeah, there is, and there's some ideas that we could talk about with you on possibly grouping and doing some other things. Typically people with 15 rental properties, there's ways we can figure out how to get around the passive loss rule. But anyway, that's another one to look at your individual situation, and we'll tell you whether it makes sense or not.
Good. I'm doing an escrow closing on June 1st. We'll do remodel for assisted living. Should I do a cost seg analysis?
Absolutely.
Especially on the money that they put into an assisted living center or residential assisted living or commercial. By the time you rehab it, buy the property, I would say absolutely too.
Oh yeah, for sure.
Yeah. Okay. And what that does is that gives you more money than to put into furniture or equipment or to buy your second home or something. So absolutely.
Yep.
Okay. I'm sorry. I was watching. I wasn't scrolling down, but I think we've got through most of the property, most of the questions here. Um, some of them were repeated once or twice, and so we've eliminated them. Steve, thank you so much for your
Yeah,
time.
thanks.
I appreciate your expertise and your willingness to come on with our students and answer their questions. Um, Folks, if you're interested at all, please do this within, just go to the analysis, you sign up for it. I've been to the website. It is so easy. Put in your name, address, how they can contact you, the date that you bought the property, about what you paid for it, and they'll tell you whether they think that this is doable or not. They'll get back to you, and so again, it seems to me like a no-brainer. Oh, you can't find the form. So protectwealth.com/CSA, Cost Segregation Authority. All right, I think we're done for the evening. Steve, so appreciate your time. Thank you.
Yep. Yeah, you guys have a great night. Thanks for having us.
Thanks for everyone for being on the call tonight. Have a great night. Stay safe. Good night.